Hi, welcome to valuationpodcast.com, a podcast and video series about all things related to business and valuation. My name is Melissa Gragg, and I provide online valuation services for mediation and litigation based in St. Louis, Missouri. Today, we're actually going to discuss a buyer's perspective and risk factors in business valuations with Al Danto. He has over 30 years of experience with startup companies, entrepreneurial companies, as well as expertise in the acquisition, valuation, and divestiture of business interests. He has served as a representative for a multitude of engagements. He has experience working with lenders, private equity groups, and individual purchasers or buyers. And he served on a variety of boards, including the alumni board of the Graduate School of Business at Rice University. He is also a full-time professor at Rice University, and he's a member of the NACVA, which I am also a member of. So welcome, Al. So maybe we can talk through some of these and it will resonate with some of our business owners.
Yeah, I hope it resonates. These are just common things, and I see them all the time. And it's even sometimes in the private equity community. People that do this a lot will still have these misconceptions. Lots of times people think that the more tangible assets that I have, the higher my valuation is going to be. And that's not really true. These are operating assets that go into generating your cash flow. So sometimes people are surprised to say, on a relative basis, a company with less assets, same amount of cash flow, same amount of revenue, typically be valued higher than a company with all these assets. Well, how can that be? Right? Well, it's because those assets are going to break down. So when I bought printing companies all those years, we had to look at the age of the equipment, deduct capital expenses, replacing that equipment out of my cash flows, right? Mm-hmm. So you have to do that. Many business owners will come and say, well, I've got all the values of my assets and I'm going to add the value of my business. Well, no, that's not true, right? These are operating assets that are required to produce that cash flow. So it's a very common misconception to hear, right? Also it's just simply a multiple of historic earnings. Take my historic earnings and multiply them by some multiple, and I'm going to be in the ballpark, right? Well, no, that's not true. Let's say that on December 30th, right, you lost one of your biggest customers, and on January 1st or 2nd, your valuation is completely different. We'll talk a little bit about COVID, but the impact of COVID on different businesses has changed valuations. So you can't just look backwards. It may be an indication of what's going forward, right? But it's a current and kind of forward-looking earnings that are critical, right? It's not just past. We were advising on about a $10 million transaction, had about $2.5 million in EBITDA, but they had construction and service, and in the year that they had the $2.5 million, they had some really, really big projects. Those projects aren't going to repeat, right? So we kind of got to take that out and say, okay, what do we expect from these cash flows? So, companies in our industry sell for 4 to 5. Well, you're not going to get just because we have to adjust these. So, right. And businesses in the same industry don't sell for the same multiple. We'll talk about that a little bit, but wide range.
And I think if you see like 1 year where the revenues jumped up by $500,000 or $1 million, you have to know that the buyer is going to ask questions about that. Yeah. Like they're going to uncover what happened there.
Yeah. You can't hide this stuff, right? It's like, poof, all of a sudden I had this year and all of a sudden my company went from value to this to value to that, right? You see it, And due diligence is going to uncover those skeletons that come out, right? They're going to uncover it as they come out. So you're not going to fool anybody,
right?
Not when they're looking at it under this type of discernment, right? And going through that. So you're exactly right for a lot of the one-time stuff that comes up, revenue and everything. So the common one that we see, Melissa, is that again, they just don't sell for the same multiple, and debt. Just because you have less debt doesn't mean you're going to get a higher valuation for your company. An example of that might be a house. If you own a house and the value is $500,000, if you have $100,000 of a loan left and $400,000 in equity, your house is worth $500,000. If you have $400,000 in debt and $100,000 in equity, your house is worth $500,000.
Mm-hmm.
This is always something, I know you run into it and everyone in a profession runs into it, but future growth. Well, if the buyer does this, and this, they're going to take this company from a $5 million company to an $8 million company.
Mm-hmm.
Well, yeah, but they're going to do that, and they're going to take that risk, and they're going to take that chance, and they're going to be the ones that are doing that. So you don't get credit for all that future. It's kind of you're projecting
Right.
future.
And along that same line, a business might say, well, they're not going to have these expenses. So these expenses should go away too. I think everybody wants the best of both worlds. The less debt, I think, is interesting because, debt is cheaper than equity. And so it blows people's minds when I say, sometimes having debt, you can grow faster, you can be worth more. And they're like, wait, we've always been like no debt equals value. And so it's a good analogy with the house as well.
Yeah, exactly. And then, with minority discounts, I think people will say, well, my business is worth, my 10% interest should be worth this. And, a lot of us in the valuation profession, we don't do as much now for stuff like this. We kind of focus on the M&A market. But, what's a 10% interest worth in my business? And it's a minority interest to somebody. So you have lack of control and lack of marketplace. So people are kind of surprised to see this. So I thought I'd touch on some of those common misconceptions, right?
Yeah, absolutely.